Welcome to Talk Tickers. So Disney just dropped its first quarter earnings, and boy, is it a fascinating story. It's really a tale of two different companies inside one Magic Kingdom. Today we're going to break down that report and the market's really surprising and pretty sharp reaction.
Okay, let's just dive right in. So on the surface, the headline numbers, they look pretty good. Disney posted adjusted earnings per share of $1.63. That comfortably beat what Wall Street was expecting, which was around $1.57. So a solid beat, right? But, and this is the big but, look what happened to the stock. Despite that nice earnings beat, it got absolutely hammered. We're talking a drop of over 7% on the day, closing out at $104.45.
So what gives? An earnings beat, but the stock takes a nosedive? This is the core question. What did investors see deep in the details that made them just slam the sell button? Let's get into it.
You have to remember, this reaction didn't just happen in a bubble. Disney's stock has been a huge underperformer for the past year, lagging the S&P 500 by a really wide margin. That context is absolutely key. It meant the bar for this report was incredibly high. People weren't just looking for a beat, they were looking for a sign, a real reason to believe a turnaround was here to stay.
And when you really start to unpack the quarter, you find what's basically a two-speed company. You have two completely different stories coming out of its main businesses, and that contrast, well, that's what drove the entire narrative.
And here's where you can really see that split personality. On one hand, the streaming business is, frankly, crushing it. Revenue is up strong, it's actually making real money now, and it's on a clear path to its big margin target. But on the other side, the mighty parks segment, the traditional cash machine, is starting to flash some warning signs about growth slowing down, and they're pointing fingers at fewer international visitors.
This brings us to a really crucial point. For years, the only thing people cared about with streaming was, how many subscribers did you add? Well, that game has completely changed. Now it is all about profit. And the key number to watch is the SVOD operating margin. Disney hit a really solid 8.4% this quarter, which proves their whole strategy of pricing and bundling is working. The streaming business has officially flipped from being a money pit to a moneymaker.
And the momentum here is obvious. It's not a one-time fluke. They're actually guiding for even higher profits next quarter. Management also made a point to say that bundling their services is really helping reduce churn, which just means fewer people are canceling. That is absolutely critical for long-term growth, and the new unified app should only make that stickier.
Okay, so what about the parks? Well, on the earnings call, management definitely tried to calm everyone's nerves. The CFO, Hugh Johnston, pointed to some positive signs here in the U.S., saying that bookings for Walt Disney World are actually pacing 5% ahead for the entire year.
Which, of course, brings us right back to the big puzzle of this quarter. If the core domestic parks business has solid bookings lined up, what on earth spooked investors so badly? Why the massive sell-off? It all came down to this. The market completely fixated on management's cautious tone about international visitors. But what was even more worrying was their comment about having limited visibility on when that trend might actually turn around. For a business that investors love for its predictability, hearing limited visibility is a major red flag.
All right, so let's shift gears and look forward. Let's see how all of this plays into the outlook for the rest of the year.
So management basically said, hey, we're sticking to our big full-year targets. They reaffirmed that double-digit EPS growth, the big share buyback plan, and their streaming goals. But the one detail the market heard loud and clear was that this growth would be back-half weighted. In other words, we're going to have to wait for it.
And that's really the bottom line here. With this new uncertainty, this new fog hanging over the parks business, the market was hoping for a confident, raising guidance to make them feel better. Instead, they just got a confirmation. And in this kind of environment, just holding steady wasn't enough to get anyone excited.
So, looking ahead, what should you be watching? Here are the key milestones. The new cruise ship is a nice, tangible bit of growth, but the real tests are going to be, 1, can streaming hit that next big profit target? And 2, most importantly, does that promised earnings growth actually show up in the second half of the year?
So, let's put this all together. After digging through the numbers and the commentary, here's our official call on Disney stock.
We are kicking off our coverage with a market perform rating.
So why market perform? Here's the thinking. The fantastic job they've done in streaming is undeniable, but the secret's out. Everyone knows about it, and it's pretty much baked into the stock price now. That good news is being canceled out by all these new questions around the parks business. It creates this balanced risk-reward situation. Until we get a clearer picture on those travel trends, we think the stock is just going to move with the overall market.
So, how would we trade this? We think a pair trade is probably the most interesting way to play it. That means going long on Disney to capture that very real company-specific win they're getting from the streaming turnaround. And at the same time, you'd short a pure-play travel company, like a cruise line or hotel chain, to hedge against that broader travel slowdown.
The whole idea here is to isolate Disney's unique story. It lets you make a bet on Disney's management continuing to knock it out of the park on streaming, while at the same time protecting yourself from the very travel risks that their own management team told us they're worried about.
And of course, just a quick reminder for everyone, this analysis is for informational purposes only. This is not financial advice.